Now, welcome back, ladies and gentlemen, to the Academy of Financial Trading's Foundation Trading and Investment Program. Now, my name is Alex Lynham, and I am one of the course educators here at the Academy. And this is just a brief video titled 5 Tips for Diversification. So in lesson 1, my esteemed colleague Mr. Tom Daly took you through what is traded on the financial markets. So whether it be Forex is what you're trading, if you're trading commodities, if you're trading stocks or indices, or government bonds. The idea for diversification is spreading the risk around all markets. Now before we go any further, we'll have a quick look at our risk warning. Remember, risk is an inherent part of trading, for without it there would be no reward. So guys, the truth of the matter is the vast majority of individual traders, retail traders, or you could just call them bad traders, only trade one market. And now the problem there is these vast majority of traders also have difficulty profiting. Now, I'm sure none of you have heard of any large funds or financial institutions that only trade one market. So the idea of diversification is that we can trade many markets at the same time, all done through technical analysis, which is our preferred form of analysis at the Academy. The beauty part is you do not need to go into the in-depth fundamentals about every single instrument, because let's face it, who's got the time these days for those sort of shenanigans? So the idea of diversification is shying away from correlated markets. For example, you would not want to short or buy into the Euro USD or Great British Pound Euro USD simultaneously. Why? Because both trades would benefit from a strong dollar. However, both are likely to suffer from a weak dollar as well. So you want to stay away from that commonality. You would not want to have opposite trades at the same time. So guys, the idea of diversification is you want to be aware of certain correlations. So the likes of gold and silver, you wouldn't want to go long on gold and silver, short on gold and silver at the same time. Then you have the likes of crude and Brent oil. And guys, sometimes it's not so obvious. We've talked about the S&P 500, so the Standard & Poor's top 500 US companies, and the likes of gold having an inverse correlation. Remember, the S&P is a strong reflection of how the American economy is doing. So when the American economy is doing well, people start to invest in other things than gold. And in doing so, ladies and gentlemen, the price of gold drops. And then vice versa, the flip side. When the economy isn't doing too good, the price of gold goes up. Remember that run to safety that Mr. Daly was referring to on lesson 1. Remember, you have choices. The beauty part about trading is that you are the boss. And being the boss means that you have to make the decision. So you want to make sure you are making the right ones. You want to focus on the markets that you are comfortable with. So I have devised here a little sample portfolio. Now at the Academy of Financial Trading, as part of our custom strategies that we teach in-house to all our students, we would look at anywhere between 10 to 15 markets at any one time. Now the reason for that, ladies and gentlemen, isn't too much of a head scratcher, we'll call it, because come on, who's got the time to analyze every single market every single day? So with 10 to 15 markets means you will not miss out on an opportunity that could be right in front of you. It just gives the trader, it gives you the time to focus on where the opportunities might be and how you can profit by them. So the idea of this portfolio, or sample portfolio in this particular instance, we'd have a look at, say, 2 currency pairs. You have the likes of the Great British Pound, US dollar, and the likes of the Australian dollar and the New Zealand dollar. Now, neither of those currency pairs are directly correlated. So if one does well, the other one will not suffer. I hope this is making sense now to absolutely every single one of you. Then you have the likes of commodities, who will have one energy. Let's say we'll go for WTI, crude oil. And then you have the likes of one precious metal. So we'll go for a bit of gold, because, ladies and gentlemen, who does not love gold? And it's doing quite well at the moment. And then you have the likes of an agricultural commodity. So a bit of sugar on the side, always good in regulated doses. Then we'll have one index, so we'll go for the NASDAQ in this particular instance, and we'll top it all off with a government bond as well. Now, ladies and gentlemen, you can always have equities as well. But here's a little tip with you. Only go for equities that are large cap equities or big cap equities. Now, what is a big cap equity? It is any company that has a market capitalization value of over 5 billion. So make sure you're aiming for those, because what we want to do is, even if our equities went against us, we would still be able to protect ourselves. So ladies and gentlemen, you want large cap equities on top of everything in front of you with quite a lot of liquidity. So that was just a few little tips and tricks on diversification. This is something we're going to cover throughout the rest of the foundation trading program. And we'll be with you absolutely every step of the way. So we look very forward to seeing you on the next lesson. And I really, really hope to see every single one of you very, very shortly. Thank you very much. Bye-bye now.